Welcome back, everybody. Today we will speak about 4 investment mistakes you must avoid at any cost. That is extremely important topic, and if you stop doing at least few of these, you will be a much better investor and your long-term results will outperform what you are achieving right now. Again, this will probably be a little bit longer video, so if you came here just for some funny short video about stocks, this probably is not for you. But if you stick to the end of this video, if you check all the charts and examples that I will give you in this video, I guarantee you that you will be a better investor. And to be honest, I am most excited about example that I will give you at mistake number 2. I guarantee you that you will be able to identify yourself with this little story. Whenever I looked recently at financial YouTube channels, I feel like all of the new videos are either should you buy Snowflake, should you buy Nikola stock after it fell down, or what you should do in this market sell-off. So I think that most of those videos are clickbaiting videos, and I wanted to make something more useful with a lot of value in itself and not only short-term funny video. But before we move on, I would like as always show you how am I performing this year. And as you can see, peak of my return this year happened at the beginning of September. I actually went over 30% year-to-date return, but in the next 3 weeks my return plummeted and now I'm sitting at around 21% year-to-date return. So just in a few weeks, 1/3 of all of my returns disappeared completely. But I'm okay with that. That is why I had a lot of cash sitting around and I actually made few new investments in these few weeks, but I will share those with you in some of my future videos. So without further ado, mistake number 1 that many investors are doing is trading too much. So as you can see, for example, on this chart of 20-year annualized returns by asset classes, average investor managed to barely get 2.5% annual return, which is just barely over inflation, but basically average investor underperformed all of the other asset classes. Actually, great long-term investing is 1% buying and 99% waiting. Or as a Charlie Munger would say, imagine that you have only 20 available purchases of stocks during your whole lifetime. So if you could buy only 20 stocks during your lifetime, how often would you trade? Actually, I need to remind myself about these rules quite often because I don't always follow them. I'm also an emotional being like we all are. But good investor is not an IQ game also. It is patience game and following rules game. Disciplined investor should look beyond short-term concerns and focus on the long-term growth potential. You can see, for example, these US bull and bear markets from beginning of the last century to 2016. You can clearly see that bull markets are longer than bear markets, and they often give you a much higher return than bear markets give you drawdown. Imagine having money invested during all of these periods without even looking at them. How wealthy would you be? So we had many financial crises, wars, terrorist attacks, bear markets of all kinds. But none of these disasters have changed the fact that the best course of action over the years was to remain invested throughout all of these crises. Another thing why individual investors are underperforming most of the asset classes is attempting to time the market. So it is favorite thing to many unsophisticated investors. So anyone who has been exposed to enough financial literature understands that it is extremely hard thing to do, almost impossible, and one that can eat away your long-term returns very, very fast. So you need to be extremely cautious about trying to time the market. So in concept, it is easy to sell stocks when they have gone up a lot, to take profits. But when do you get back in? What if, for example, they go higher? I mean, what we've seen some of the investors saying for last several years, how stocks are really, really expensive. So when do they get in? How many possible profits have they missed because of not being invested in stocks? I used to be one of those guys, but now I'm looking potential ways of, for example, hedging my portfolio, but staying invested, instead cashing in most of my stocks and waiting for a pullback. I think that's a more healthy approach. You can find at this moment many investors bragging online, claiming they have sold their stock at the top and that they achieved a lot of huge returns on their investment. We've seen a lot of stocks flying and giving you triple-digit returns in a very short time period. But how many times have they been wrong before they were right? What are their annual returns over a lifetime of investing? Not over the last few months. Over the very long term, stocks are going to appreciate and follow GDP growth. If you are out of the market long enough, you are virtually guaranteed to lose. Another very costly thing that a lot of individual investors are doing is investment turnover. Many investors can't help, again, I can include myself into this. Many investors can't help but cash in on their gains as soon as a stock is up 10, 20, 30 or perhaps 50%. So they might buy back the shares at the same price or higher several months later when they realize their mistake. For example, that is actually what I did with my Revolve stock. But I have learned my lessons and I have paid for my lesson. And yeah, I want to share my mistakes so you don't have to make them. Even worse thing would be that some investor would refuse to invest again in great companies that they have previously sold at lower prices. So they can leave long-term compounders out of their portfolios forever. So we are constantly surrounded by market forecasts, by financial news, and that they push heavily a narrative that suggests you should reorganize your portfolio. If you spend too much time listening CNBC, Bloomberg, or reading some perma-bears on Seeking Alpha, for example, predicting that crash is upon us every other week, you will think that the world is constantly about to collapse. You will bring big burden on your emotions. The so-called market pundits that are warning you about the next stock market crash today are often the same ones who were telling you to sell stocks in March of 2020, when the S&P 500 was trading below 2500. So it's essential to look at the past articles of any author you read and see for yourself who are you dealing with. Do your own homework. Don't get emotions make decisions for you. That's why I didn't want to make video what should you do when market sell-off begins, what should you do during this market sell-off, panic, red headlines. Basically a great way to avoid common investing pitfalls as this one would be just to tune out the noise. So investment mistake number 2 is relying on your emotions. So now we are coming to some of the most excited story that I have read in a long time. So this story is about Stanley Druckenmiller, former George Soros analyst and iconic macro investor. So look what he said on a recent interview. So I'll never forget it. January of 2000, I go into Soros office and I say I'm selling all the tech stocks, selling everything. This is crazy, so he's referring to valuations. This is crazy at 104 times earnings. This is nuts. Just kind of as I explained earlier, we are going to step aside, wait for the next fat pitch. But they started making 3% a day and I'm out. So his competitor started earning 3% a day while he was staying sideline. It was driving me nuts. I mean, their little account is like up 50% on the year. I think Quantum was up 7. It's just sitting there. So like around March, I could feel it coming. I had to play. I couldn't help myself. And 3 times during the same week, I pick up, don't do it. Anyway, I pick up the phone finally. I think, look at these guys. I think I missed the top by an hour. I bought 6 billion worth of tech stocks. And in 6 weeks, I had left Soros and I had lost $3 billion in that one play. So he invested $6 billion because he couldn't stand watching other people earning huge returns while he was sitting sidelines with cash. You can feel how his rational brain is fighting his emotional brain. It's just unbelievable. And then, this is even the best part. You ask me what I learned. I didn't learn anything. I already knew that I wasn't supposed to do that. So he knew valuations were high. He knew he cannot, on the long run, get above average return on these stock valuations. He said, I was just an emotional basket case and couldn't help myself. So maybe I learned not to do it again. But I already knew that. So I think that all of us can identify with at least some part of this testimony of Stanley Druckenmiller. And you can see how even extremely intelligent people with a lot of knowledge, with a lot of great performance in their past can get completely overtaken by their emotions and do really stupid mistakes. I cannot put it any other way. When we let our emotions get out of check, we can make bad decisions when it comes to money. If that bad decisions compound, the chances of that perfect retirement you are currently envisioning might not come to fruition. Humans are rational beings, but money reinforces 2 very powerful emotions, and those are fear and greed. While it feels good when your friends, for example, family and co-workers agree with you or have similar opinion, when investing, doing what everyone else is doing is not always the best course of action. So to properly invest you need time and you need emotional fortitude to stick with your financial plan. You simply have to trust the process. I read somewhere this. A good definition of an investing genius is the man or women who can do the average thing when all those around them are going crazy. So if people around you are buying expensive stocks because they are jumping 10-20% every day or every week, you should stay average. Don't buy those stocks. Same goes for the opposite. If people are panicking and are dropping their stocks because they cannot handle losses, again, you should just stay average. That is what will outperform on the long run. It is extremely hard to be sane in those times, but that is what pays off. Unless you are willing to identify it and address, chances are your emotions will eventually get in the way. Again, we are influenced by our own fear and greed. This is, for example, a good way to identify if your emotions are getting best of you. If your decision to buy or sell cannot wait for a few days, you are likely making an emotional decision. So a great long-term investment decision shouldn't require perfect timing. You should always be able to sleep on your investment idea, because great investment ideas are not made in a rush. So using systematic investment strategy can be a powerful tool. For example, this can take form of safeguards such as a maximum amount added to an individual stock, for example diversification, or a limit on the funds you can invest in a single month. So that would be diversification over time. So investment mistake number 3, which you should avoid at any cost, is chasing returns. What does that mean? Well, let me start with a Aswath Damodaran quote, and he is a professor of finance at the Stern School of Business at New York University. So look what he said. In my 4 decades in corporate finance and valuation, I have seen many new and revolutionary ideas emerge, marketed as the solution to all of the problems in business decision making. Most of the time, these ideas represent either a repacking of existing concepts with a healthy dose of marketing and selling, usually by consultants and bankers, and their magic fades quickly once their limitations come to the surface, as they inevitably do. What does this actually mean? Well, chasing returns is the practice of taking excessive risk by selling what you own in order to concentrate heavily your portfolio into what everyone else is buying. So many companies have more than doubled so far in 2020, but that doesn't mean that you should suddenly sell all your underperforming holdings and blindly replace them by the top performers of the market at any given time. So it might be tempting to sell all of your portfolio positions in the red to add to those ones which are in the green, while selling your losers and adding to your winners over time is a sound long-term investment strategy. Any kind of portfolio rebalancing requires a lot of nuance and precaution. Because switching your money from big losers to whatever is hot can lead to selling low and buying high. Of course, there is nothing wrong with reallocating some of your portfolio from losing to winning positions, but it must be done with extreme vigilance. If you do so in the middle of a very volatile market, your long-term returns could be permanently damaged. If you are properly diversified, there will always be a portion of your portfolio that underperforms the market. And that is okay, that is completely okay. It should be natural to have a portion of your portfolio that you temporarily hate. If you are properly diversified, chances are that you will hate different parts of your portfolio over the years. Just look at some of my position. PRDO, for example, it went down, but I was actually buying it recently. Stocks don't go up in a straight line. It's not uncommon to see stock go nowhere for more than 3 years before it generates outstanding returns. For example, you can see a chart of the Tesla in the past 5 years. And the same way it wouldn't have been wise to sell Tesla before 2010, just because the stock was performing poorly. It would be a mistake today to triple down or quadruple down on Tesla just because it has performed well. So chasing returns is essentially making large portfolio reallocations solely based on recent stock movement. So if you are investing for the long term, chasing returns will likely adversely impact your overall performance over the years, with very suboptimal entry points. So you should really avoid doing it. In most cases, what compels investors to chase these returns is usually their lack of patience. And we talked about patience in the first part. Imagine that you can make only 20 purchases during your whole lifetime. Don't do any rush decisions. So Charlie Munger explained it very well. It's waiting that helps you as an investor. And a lot of people just can't stand to wait. If you didn't get the deferred gratification gene, you got to work very hard to overcome that. So before you rebalance your portfolio, generating gains or losses, or before, for example, you throw in the towel on what may become a great missed opportunity, you want to ask yourself if you are truly given enough time for your bullish thesis to materialize. Now you are coming to investment mistake number 4, and that is keeping too much cash. When the market is volatile, it can feel much safer to watch it from the sidelines. Perhaps you could even see it on my portfolio in last several months. And historically at least has been a mistake. Cash itself is a depreciating asset. But of course it is also an essential tool to buy other assets. So finding the right balance of cash in an investment portfolio can be challenging, particularly for those who are not generating new income or savings to add to their investment portfolio. Of course, we can check example of Warren Buffett, because he has been known for keeping huge cash allocation in his portfolio at Berkshire Hathaway. So at the end of the second quarter, Berkshire had almost 150 billion in cash. But that cash allocation actually is less than 40% of its equity portfolio. And also Warren has insurance business, which requires large cash allocations. So if you have more than 50% of your liquid assets in cash, you are likely permanently damaging your long-term returns. My personal standpoint is to have between 10 and 30% cash in your portfolio. That is what I will be looking to have in the future. If I think that stocks are quite expensive, I will be closer to 30%. If I think they are not so expensive, that valuations are okay, if I find some good opportunities on the markets, I might be closer to 0 to 10% cash in my portfolio. So if you are a new investor, waiting too long to start is one of the most crucial mistakes young investor can make. For example, if you hold stock that is compounding at 20% annually for 25 years, you return 100 times your money. But if you hold it for 10 years, you only returned 5 times of your money. Every year you are not invested, you are missing out on the benefit of the most powerful tool you have on your hands, and that is time. Most individuals don't have the luxury to have capital available to invest. But if you are lucky enough to have position to allocate capital to markets, not investing enough when you have the resources is one of the most damaging decisions you can make for your portfolio. Staying in cash, of course, gives illusion of control and security, but only for a moment, because in fact your cash position is losing to inflation every single year. And that's simply another form of market timing. Look, make no mistake, if you ever find yourself tempted to raise cash by selling a lot of your best performing positions during market rally, all you are doing is another form of panic selling. You are effectively, actively trying to time the market. Only with the discipline of staying invested through time will you truly benefit from the power of compounding over the years. If you get in the way of your portfolio and try to stay in cash to outsmart the market and wait for the next market crash, chances are you are doing a lot more damage to your long-term returns than if you were sticking to a long-term focused investment plan. That is what I said when I told you in, I think, number 3, that you should trust the process. This is the part that I should be telling myself several times here, because I'm doing this mistake quite often. This year I was a bit lucky because I had like 70% of my portfolio in cash before March. That is why I'm outperforming S&P 500 quite hefty right now. But if there was no coronavirus, maybe my cash would still be sitting at around 70%. Thank you for watching this video, and if you liked it, please subscribe and see you next time.